Welcome to this edition of Citrin Cooperman's Corner Chats. I'm Peter Katz of Westfair Communications, publisher of the Westchester and Fairfield County Business Journals, westfaironline.com, News at Noon, and other digital newsletters to keep you fully informed. On this edition, we'll be chatting with Heather Oboda of Citrin Cooperman, and she's a tax partner with nearly 2 decades of experience in public accounting. Now, Heather has a focus on trusts and estates and provides tax, financial, estate, and succession planning services. She's also an active member of the firm's trusts and estates practice. Welcome, Heather.
Thank you, Peter.
And Heather, we're coming up against what's known as a sunset situation where tax rules and regulations may change. Could you explain what to expect?
Oh, happy to, Peter. So right now we are set to have a sunset of the estate tax exemption. For 2024, the exemption is $13.6 million roughly per person. And it's already been released that it'll go up to $13.9 million per person for 2025. But come December 31st, 2025, if nothing happens in Washington, then what's going to happen is that the estate exemption is going to sunset, and it's going to go back down to what you usually hear is $5 million, but it's really $5 million indexed for inflation. So that would be about $7 million. So if no one does anything in Washington, this will happen. So there doesn't need to be an act of Congress or anything else. So I know that there's a lot of concern about the change in the presidency, and there's talk that maybe it'll be extended. But again, right now, if nothing happens, this is going to sunset and everyone will go down to 7 million. So we're concerned about using those exemptions now.
Well, of course, there could be dramatic implications for someone with a large estate, perhaps a business owner who has a property to leave to his or her heirs. Are there things that people can be doing now to perhaps plan for any eventuality regarding the estate tax exemption?
Absolutely. Everyone has a gift exemption that they are allowed to use for any individual. It's almost like a free gift. It doesn't use up their $13.6 million if they give to an individual $18,000 per year. And next year it will be increased to $19,000 per year. So someone could give cash or securities or part of a business and not use up any of their lifetime exclusion. If they wanted to gift more than that, they can, and it would just eat into that $13.6 million exclusion. And also, married people can split gifts. So instead of making an $18,000 gift, they can make a $36,000 gift without even beginning to eat into their lifetime exclusion. So these are great opportunities for our clients and other people doing planning right now. So you can give up to $13.6 million. And the IRS has said, and Treasury has said, that they're not going to penalize anyone if they give up to that $13.6 million. And then after the sunset, the exemption goes down to 17 million and the person passes away. They're not going to penalize them and make them pay tax on that $6.6 million difference. Instead, it's almost as if they have an estate tax credit for that period of time and will not have to pay estate tax on those gifts that had been made in the past.
You know, this whole thing sounds so complex. How do you explain this in words of one syllable to your clients? Or do you have to go in drilling down into every detail in order to get the point across and explain the options to your clients?
Personally, I like to go through a client's estate plan and their assets and map out what their estate plan is now and how it would layout if they passed away today under the current rules and under the sunset rules, and then start putting in planning opportunities along the way so that they can see the impact. I think that people do better with looking at numbers and seeing the effects as opposed to speaking about numbers. At least that's me personally. I like to see the overall outcome.
So it may be easier to understand if you can get it all down on paper in some usable form. Is that fair to say?
That is very fair to say. I personally like to work with a nice Excel workbook and run various different scenarios.
Well, Heather, we know about the federal tax situation, but don't states have taxes too?
Yes, yes, they do. There's a handful of states that have an estate tax and only one that has a gift tax. The gift tax is actually our neighbors of Connecticut. But luckily, the exemption for Connecticut matches the federal of $13.6 million this year and $13.9 million for next year. For New York, we do have an exemption. It's close to $7 million. And it's really not an exemption, though. However, it's more of a cliff because if you go over that amount, you then go and pay on $1 of estate assets. And that could be up to 16%, which is quite sizable.
You know, some people may feel that they just don't have enough assets to bother thinking about the estate tax. But has it been your experience with your clients that when you start analyzing the value of assets, it really can expose them to tax liability?
Absolutely. I believe that more clients are focused on the federal estate exemption and think that they would never get to that number. But that $7 million dollars is very close to where most of our clients could be when you do bring in their businesses and the real estate. We have had a lot of real estate appreciation in this area, especially during COVID and post COVID. The property values have gone up. And also, businesses have gone up, and clients may be focused on what their current capital account is and not focus on the resale or the valuation of their business. And when they get a valuation of their business, it could come in much higher, especially if it's 100% owned and there's no ability to have any discounts for lack of control or marketability.
Are there things that can be done in the way of planning or maybe shifting assets to family members while you're still alive that can help keep one away from the reach of the tax man?
Absolutely. One of the things that people can do now is to do some gifting of these family businesses if they have a successor in mind, a family member successor in mind that they want to start transferring the ownership to. By gifting a portion of the business, they can, instead of using up their full exemption or using a larger amount for the gift, instead they can take valuation discounts for lack of control and marketability. So that for their decreasing the gift and use of the estate tax exemption, and they can do this over a period of time. There's also um, opportunities to set up maybe a family business and gift multiple um, pieces of the business into trust for various family members that can also work in their favor.
Heather, when you go in to see a client and take a look at their estate tax situation, what is the process that you follow? How does it work? Suppose I'm a new client and you come over to see me. What will you be asking me for? What will you be looking at in what I provide?
Well, I'd start with looking at what your actual plan documents are right now. So, do you have a will? Do you have a revocable trust? What does it say? Where do the assets go? Then I'm going to also look to see if you have any brokerage accounts, banks accounts, and IRAs. Have you reviewed your beneficiaries lately on any of these accounts? Are they transferring death, do you have another person on the account so that if something happens, they'll have access to those funds to help pay your expenses if you are unable to. And I'll also check to make sure that if they have insurance, seeing who the beneficiaries are on those, maybe even reviewing the policies, the insurance policies, to see if they could get a different policy that might be more economical, or look to see if there's any term policies that may be expiring soon, and plan to see what other options are available if the client is still insurable.
Some people may still harbor a belief that insurance proceeds are tax exempt. Is that still the case?
Well, the income is tax exempt. However, they may not be estate exempt. So if you have an insurance policy and your wife is your beneficiary, then that would transfer to her upon your passing. It would be included in your estate as one of your assets, but because it goes to your wife, it would be exempt for the marital deduction. However, if it was owned by you and your children are the beneficiaries, then that would be a taxable asset. And someone would have to pay estate tax on that if your estate was over the 13.6 million. There are ways to work around this to keep insurance policies out of one's taxable estate. And that is when you set up an insurance trust, and instead of you buying the insurance policy, the trust buys the insurance policy. And with the trust owning the insurance policy, well, it's going to need money to pay its premiums. So you would gift to, or could gift to, the trust so it can make its insurance premiums. Right now, as we're focusing on the sunset and possibly accelerating the use of the people's lifetime exclusion by making more gifts, I would suggest that people who have these trusts and are planning to use up or go somewhere between the $7 million and $13.6 million of gifting, that they possibly pre-fund these trusts now, because when the sunset happens, there may not be the ability to make these gifts the same way they had in the past if the premiums are over 18,000 and there's not multiple beneficiaries, so that it gets very complicated.
Is it your experience that people know about sophisticated things like trusts, or is this generally a new field when you bring it up to a client?
I think most people think I don't have enough money to need a trust, but what we found post COVID is that everyone really should put their assets into a revocable trust. They're not just for Florida anymore, to avoid probate. But we found that during COVID, the lines and waiting time with the surrogates courts to get letters of administration for estates took so much time, and families were having so much difficulty getting access to the decedent's assets in order to pay funeral expenses or any like maintenance of existing property, that we really find that now is the time for people to start getting revocable trusts as part of their planning documents. And after they get the trust set up, they must then retitle the assets. They don't retitle the asset, the bank account, the brokerage account, then it's a active utility, because there's nothing has been done, and those assets still have to go through probate.
Speaking in general terms, to what extent does your work have to be personalized for each client? Um, are there common themes that you see across the various estate and trust planning and wills and so forth from client to client? Or is each one so specific that it really has to be unto itself?
Oh, clients are very unique. Every estate plan on every 706 or ET 706 for Connecticut, for New York, is different. And so we have to take on each engagement as if it's a standalone client and really wrap our arms around the engagement and understand the complexities to it. And also remember that these are families and they're going through an emotional time right now. So it's not an automated process. Not every estate is one size fits all. So we have to cater and craft each estate differently.
At what time period should you start thinking about estate planning? Let's say if you're a business owner in your 40s, in your 50s, can it wait until you're in your 80s? When do you really have to get serious about it?
Unfortunately, I think we all learned back in 2020 that nothing is certain and anyone could pass away at any time. So we really need people to start planning as soon as possible, especially if they have families and children, but businesses owners also. Really, as soon as you start planning, it's for the best. I mean, you may not be planning for succession planning for your business if you're in your 40s, but you could start considering it. Maybe you want to retire early, and but if you are a young person and you have children, you definitely should be doing estate planning just to make sure that there will be coverage for your children if God forbid something happened to you and your spouse. So these are not things that you do when you're older. It should be done early on and constantly reviewed, renewed as life happens. And as laws change, your documents really should be reviewed because something that was in a document pre 2012 could be not good anymore because the laws have changed and there's new planning opportunities. In 2012, the IRS came out with portability, where if someone passes away and doesn't use up their exemption, they can port it over to their surviving spouse. This is huge, and it's very helpful to have different opportunities built into your documents so that you can either fund a trust or port over the unused exemption, but there should be the ability for the executor to make decisions on behalf of the estate. And if it's an older document, these opportunities may not be there. Or if there are opportunities, it might be more costly and to deal with the surrogates court.
So that's called portability. And would you say that's a word that people need to become familiar with?
Yes, yes, it is. We also, you might see the acronym DSUE, DSUE. So that's the deceased spouse unused exemption. And it's only a federal thing, except for the Hawaii. That is the only state that has DSUE. So it's really helpful in a state like New York, where the federal exemption is much higher than New York's exemption if to review your documents. We find many times that the document has put to say, fund a credit shelter trust up to my unused exemption. Well, if someone has $15 million, 13.6 million could be going into this credit shelter trust. But remember that they only have a $7 million exemption for New York. So then you have created a tax event for New York. And I have seen numerous times where our clients have come in after someone has passed away and been shocked at a $1.5 million tax bill 9 months after death to the state of New York. Nothing to federal, but to New York when they thought that everything really goes to the spouse. It's the first to die, so there is no issue. These are important things to review.
Heather, in listening to you, this seems so complex that I get the impression that only a fool would undertake his or her own estate planning without guidance from a firm such as Citrin Cooperman.
Yes, I think that their clients should be taking their estate plan into consideration and working with a professional. they should take it into consideration if their exemption, if they think that their estate is going to be above $7 million by itself or as a joint group, because with the planning opportunities that are available, one of the things we didn't really touch on before was with portability, that an estate tax return needs to be filed for the deceased spouse in order to obtain that unused exemption and port it over to the surviving spouse. Now, no one should be concerned that maybe someone passed away and they didn't have the correct, um, they didn't do the filing and all is lost. The In the past, someone had 15 months to file an estate tax return and elect portability, and then the service came out and said that you had 2 years after death, from the date of death, to file, and then they came out and said 3 years. Well, now they've come out and said it's 5 years. So with all the uncertainty of the exemption sunsetting, if someone has passed away in the last 5 years, they should reach out to a professional and see if it makes sense to file an estate 706 on behalf of the deceased spouse to port over the unused exemption for the surviving spouse. I call it an insurance policy, and for estate tax for the surviving spouse. You don't know what's going to happen with the exemptions in the future. You don't know what's going to happen with that surviving spouse's assets. Maybe they have the next NVIDIA, who maybe they own Apple, and it's going to go through the roof. Who knows what is in the estate and what's going to happen? Or maybe they just hit mega millions. So let's talk about these things for a little bit of maintenance and doing these compliance filings. It might save the decedent's or the surviving spouse's family millions of dollars down the line.
So really, it's a matter of knowing what to file, when to file it, and knowing what the law is, and knowing how to deal with any possible changes in the law.
Correct. That I spend the majority of my time understanding what's going on. That's what I do. I follow what changes are happening in the law, how things are going to impact our clients. This is not something that is done on the fly, or it's not something you should be doing on your own. We have professionals that can help with these situations. You don't do your own, dental work, probably. I know I can't cut my own hair. We all go to professionals for everything else. We should go to professionals when it comes to our estate plans, because we're talking about leaving assets to the next generation.
What was it, if there was one or two particular things that got you interested in this specialty?
Well, honestly, I grew up in working in my mom's law firm. She's a legal secretary that specialized in real estate and trust and estate. So I had an early education in trust and estate work. But then moving on to, I was working in public accounting, and my father passed away. And so I had personal experience with dealing with that as well, early on in my working career. And just understanding that you need to have your documents in order. You need to leave everything in a proper manner and not scattered all over the place, really taught me what clients shouldn't do. Uh, I actually met an advisor once who said that one of her clients left a love letter to the surviving spouse, for when he passed away. And in this love letter, it was obviously about all the wonderful time that they spent together and how grateful he was for the time. But then he also included, here's where all the assets are. Here's how everything is organized. Go to this person. And it was so clean and easy. for the surviving spouse to deal with the estate. That was just one of the nicest gifts someone could give when they passed away, was not creating more stress and distress when someone is emotional as it is, rightfully so. You unfortunately sometimes people are grieving, and then on top of their grief, they're going through anger because they might be confused and not know what's going on. And so, as organized as you can have your documents be and your assets be, the better it is for your surviving spouse or your children or whoever is going to step in and administer your estate.
So, is the bottom line lesson don't be afraid or reluctant to talk about these subjects, which some people do consider to be taboo?
Yes. I do love when clients will say, well, I'll be dead, so it's not my problem. But again, your family's going to be down here stressed and scrambling, so that's not very nice. But yes, people should have these conversations. We're not saying that you're going to pass away tomorrow. We hope that you live for another 50 years or more. But if no plan is your plan, just consider that it might impact others along the way.
Well said. And on that note, let's conclude this. Heather, thank you so much for being with us on this edition of Citrin Cooperman's Corner Chats. I'm Peter Katz of Westfair Communications.